So now we have covered the basics of market microstructure. We have talked about how markets are essentially moving, what is liquidity, what is volume, and all these kind of essential things. So at this point you should be understanding how to look at DOMs. You should be kind of a set on what markets you are going to be trading, and all the different requirements for them to trade, and obviously and how different futures contracts you can be trading, and so on and so forth. But the concepts of the market microstructure, I will be repeating them throughout the lessons. So if you didn't really catch up on that, don't worry. I will make sure to kind of revisit them once that's relevant. But we are going to price action. This is a important thing to understand for me. Although price action is this kind of topic that is so often used, and it's fairly simple. The truth is that it just simply works, and once you start understanding price more in depth, and you will be able to spot how people are positioned, even based on a price action itself. It can be a really helpful thing to have inside your toolkit. Also, I am executing trades based on a different price patterns that I will cover in the videos further on. So price action extremely important. The higher time frames you will be using for trading, the more importance will price action actually have for your decision making. So definitely, you want to be kind of paying attention to that. If you picked up the blueprint in the past, you might have seen the patterns I will be covering already, but I will also go more in depth in different kind of a price structures and situations which you will see on your price charts. So let's actually jump into this. The first things first is that I didn't set this up for a presentation, so you need to give me a 1 second and I will do it really quickly without anything else. So the fractional nature of price. If you take a look at this chart right here, you won't be able to tell which time frame is this, and this is actually quite a interesting thing. If you are actually curious, these are the Nikkei futures on a 5-minute chart. Some of you might have noticed this bit of gaps, which shows that markets were closed for a bit. But the fact that the price is fractal and all the things that you see happening on 5-minute chart also happen on hourly chart and also happen on a weekly chart is giving you the option to trade basically any time frame, and you just need to understand different nuances of those time frames when it comes to granularity and what kind of a things are affecting the price movements. But besides that, like I said, price is fractal. You can trade basically any time frame. The same as you can trade 5-minute chart the same as you are trading a weekly chart, for example. If we take a look here at a this is a Luna USDT, you can see that let me just highlight this so you can see it clearly. Market basically put in this kind of a pattern when there was a level of support which got broken here to the downside. Market then kind of reclaimed it, tested it here, and moved away from it. If you take a look inside this highlighted blue box here, which is this thing right here, you can see that the same pattern, and this is the H4 level, which is this one basically. You can see that the same pattern is happening on a 30-minute chart. Market hits the level of support, breaks below it, survey reclaims it, tests it, going to test it again, and rally from there. You can also see the difference of kind of how deep under this level the market went on a 30-minute chart compared to the H4 chart. Obviously, this is once again cause of a kind of a resting liquidity at these levels. So on the lower time frames, you will more likely to experience these kind of a bigger overshoots of the levels compared to the higher time frames. So that's one of the things. You know, the lower time frames are much more granular, so although the patterns will kind of be happening over and over again, the probability of their kind of breaching a little bit more on lower time frames are basically higher than on the higher time frames. And this brings me to the time frames by themselves. Like I said, the lower time frames are more granular with more points of references. What this means is obviously the patterns and different situations will be much more repeated often on lower time frames compared to higher time frames. For example, a situation like this, when the level of support is lost, then is reclaimed, which can bring a trading opportunity on this H4 chart, can happen once a month, but on the 30-minute chart it can happen once a week. Basically, that's kind of the point of that. Every large trend starts at lower time frames due to fractal nature of price. This is important because if market is hitting a key weekly level where the multi-week trend can be established, you will see the signs of that on the lower time frames. Only watching a weekly chart in this example would get you pretty late to the trend, but because you would wait for any sort of confirmation on a weekly chart. But if you will go to the lower time frames, you will be able to spot these changes more quickly. And as I said, the lower time frames can both reveal and disregard higher time frame trends. Also, this would be kind of a situation where you expect new trend established, but on the lower time frames you will just get these signals that it's not likely to happen, and you will be able to kind of scratch a trade rather than just waiting on the weekly chart. Goal of the lower time frame trader is to play intraday rotation thanks to analyzing market microstructure and what other participants are doing. This is pretty self-explanatory. If you are trading 5-minute chart, for example, you should not be expecting to hold trades for 3 days, because that's not how things generally work. If you are taking a trade because you see some stops hit or someone is trapped on a 5-minute chart, you can expect a reaction from that level, but you shouldn't be expecting that it will establish a new monthly trend. So the relevance of time frames is really important as kind of a expectations how long you should be in a position. Usually the low time frame tradings offer plenty of trading opportunities, but are harder to trade due to amount of information coming to the markets. This is the thing that I mentioned in more kind of a granularity of lower time frames. If, for example, people who only trade market structure and they are watching from these kind of a breaks of structure, you will see plenty of them during the day. If the very simple teachings of market structure, the higher highs and higher lows, this will kind of the break of structure will happen 10 times on a 5-minute chart during the day, but this doesn't mean that the whole trend will change 10 times during the whole day. So when you are trading lower time frames, you are exposed to a lot of information, and you need to be able to filter it out, which is done by using any sort of a higher time frames or any key reference point in your trading. The higher time frames has a less reference point in terms of price actions. Markets are moving based on long-term fundamentals. When markets are going to hit a monthly or weekly level of support and then establish a new trend for there, which will be lasting for a couple of months. It's not because the market hit the weekly support or resistance. It is because something based on a fundamental beliefs in that given market has changed. Although these things usually are happening at kind of a key technical levels, the move itself is not driven by the fact that market hit any sort of a support or resistance. This is kind of an important thing to understand, and what people kind of a lot of lack understanding, and a lot of people are just completely disregarding any fundamental events in the market. But on a large scale, markets are always moving based on fundamentals. It just happens that these things happen at key technical levels because obviously a lot of people are seeing them, and they are kind of anticipating any trading activity there. So higher time frame traders spend less time watching charts, but also have to pay more attention to what is going on outside of the price action. This is basically what I covered now. The bull market in crypto didn't start because Bitcoin flipped resistance to support back in 2020 or where it was. It started because a lot of people were coming into the space, and crypto got a lot of traction, which was driving prices higher. Obviously market happened to show these kind of signs of technical levels, but the move itself wasn't driven based on a SR flip. Basically, the goal of a versatile trader is to be able to perform both lower and higher time frame analysis to capture trades intraday, but also know when markets are reaching key higher time frame level, which can lead to large trends. This is a really important thing, and this is something where you kind of want to be at the end of everything. Even if you will decide, for example, if you will be trading a 30-minute chart, but market is coming into the level where you think that it can rally for a longer period of time, you shouldn't really be trading. If you are, for example, trading from just like one 30-minute level to another, when this kind of a new piece of information comes to the play, you need to be then able to take a hands off and hold trade for a longer period of time. I will be going through kind of setting different biases later on, and how you can hopefully be doing that. But that's the ability to recognize when trades can run and actually let them run will be extremely helpful to in growing any sort of account. Also, when it comes to time frames, the time frame by itself is not important. It doesn't matter if this is H4 chart and 30-minute chart. It can be 3-hour and 25-minute chart. For it's completely it really doesn't matter. Anything below the daily time frame, it's totally up to you what you will use. Obviously most people just use these because they are preset on a trading platforms, but the chart itself doesn't really matter. The same thing goes with a lot of simpler price action strategies are, for example, based on where market will close. Well, like you are trading hourly time frame and you are looking where our candle is about to close. If it's going to close below the level, then it's a short trade. If it's fail and close above the level, it's a long trade. I don't think this is the absolutely best way of doing things, because it's more about the overall volume and participation inside that bar itself, rather than it hits some predetermined time cycle and it just closed. So I will be using simple time frames, H4, 30 minute, 5 minute, some tick charts, but it really doesn't matter. It's more of a what is actually going on, rather than where the candle close itself. There is this kind of a change of this dynamic, I think, when it comes to daily, weekly or monthly charts, because these really bring a lot of attention from a lot of large players in the markets, so also kind of end of the day, in a futures, you have a settlements. It's more important when it comes to these high time frames, how these candles are closing and all of this, but for any sort of intraday time frame, this is not a key thing to be watching. Efficient versus the inefficient price moves. So markets basically are doing only two things. I know most people will tell you that they are either trending or ranging, but more in my kind of a opinion, they are either efficient or inefficient. This is the USD Swiss chart, and you can see how markets, this is basically the two-way auction. The buyers and sellers here kind of agree on these prices. Markets just kind of a rotating up and down basically, but once new information comes in, the market will become more inefficient, starts to create these liquidity gaps that I already covered about, and these are your inefficient kind of a price move in here. Once again, then markets are going to pause, become way more efficient, here, also here, but then do these kind of a scan this is the efficient price move, inside this kind of a channel. Then the large inefficient sell-off, the liquidity gap is created, then the liquidity gap is filled, markets continue once again doing this kind of a more efficient channel. New piece of information comes in, this inefficient move happens, it gets retraced and tested, market moves back up. Obviously, if you haven't figured yet, these kind of a inefficient moves are your sort of opportunities where you want to be buying and selling. You don't exactly want to be initiating trades in these areas, because you will be stuck in those trades for a bit. If you for example, this can be kind of considered that inefficient buying, going up even without kind of looking at volumes. Market then hits this level of resistance, it fails, you can go short, you have this large inefficient sell-off, but this is all happening on kind of a pickup of volume. Market then retraces to this level, like I said, and sells off again. Selling here is great, not only because you are kind of going with the overall trend, but because you are selling into this kind of a fast-paced inefficient move, which is more likely to get retraced, rather than if you miss the move, you're gonna sell somewhere here and then you will just kind of spend this whole time inside this range, which this is I think hourly chart, so you'll just be stuck in for a couple of hours. And we can see that this is a hourly chart of Bitcoin. We can start seeing these things when this is the relative volume indicator on kind of the simplified version, when you have this sort of a mean here, and I'm just kind of you are just looking at where the volumes went a little bit outside of the mean. So you can see here, the really efficient move down, then you have this kind of a inefficiency to the upside seen on the relative volume. Market, a lot of buying happening inside here, market fails to sustain the momentum and has this kind of a quick flush to the downside. Then it once again slows down inside this range. Once these high volumes come in again, you have this inefficient move to the downside, really quick move, pick up on the relative volumes, market is going to hit some higher time frame level and reverse from there. And you can see anytime these relative volumes kind of get picked up, instead of like this where market just got stuck there for a bit, but you can see every time these things started to picking up, some sort of a sharper move is about to happen. So this is why you want to be watching volumes and who is doing what and what's going on, because it can give you the clues that some sort of move is about to happen and you won't be basically stuck inside a ranges for too long. this is the same chart, it's just zoomed in. What is you can see the candle coloring here, as I mentioned. Large pickup in volume here, buyers failed to kind of hold it, the inefficient move up, quick sell off, large volumes to the downside, market moves. You can see basically anytime the large volumes kind of get picked up, market will do any sort of move. So how market is approaching the level? There are basically two ways of markets going to levels, and let me just draw this again. It's going to be better. So the first one is this kind of a inefficient, basically we have a level of resistance, and market will do something like this. Oh, this is disappearing again, sorry. We have kind of this, and market will just move sharp to the level. Compared to that, you have kind of this sort of a slow grind towards the levels. So which one do you think is better? It's going to be this one. When markets are really thin and moving really quickly to the levels, this is where lot of kind of a also retail traders, for example, will initiate these kind of a attempts for a breakout trades. A lot of people are chasing those prices because market is moving quickly, and they are kind of just rushing to be buying with everyone else. But if market is going to the key level, fading something like this is awesome, because obviously the likelihood this will just completely drop down is much higher than compared to this, when market is just kind of a slowly grinding. There are going to be the examples of compression where this can a little bit change, but if you have this just overall kind of a clean slow trend which just coming into the level, the likelihood of the level is holding is not that big, because obviously there is not really anyone who wants to aggressively sell it. As you can see, level of resistance here on a Bitcoin, look how just price is going slowly to it. And usually you will very often see these kind of patterns when market just grinding, then will make this kind of expansion leg before reversal, which is kind of this slow grind, then this inefficient move to this was a kind of a weekly resistance area, I think, and then after this was FOMC, and after FOMC that it sold off. So this is the thing, when markets are moving fast to the levels, people are usually scared, but people are scared or are chasing, but these are the best kind of cases where you want to be buying or selling. And we can see this. This is a Bitcoin. This is 12-hour chart actually of that. The first time we went to the all-time highs basically, and you can see that we had this level of resistance, and market was just kind of very slowly grinding towards it. So and it's just get tested. So all the orders that are resting here are just getting consumed, but the market is not really selling off. So once it's kind of a consolidating below the resistance, then you have this big kind of inefficient candle to the upside, a lot of buying, people are trying to chase this, move to the upside, but market cannot sustain the momentum and quickly sells off. Okay, so this is one of those things. You have a similar thing here, but this is the case of decompression, which I will be covering. I think it's in the next lesson, so you will know in a bit. But the structure here is more of kind of a you have a level of support, this get breached, then you make a next level of support, this get breached, and then it moves up. But here you have these kind of a higher lows, just kind of all the stops from the longs are just building, and if this is going to happen, this is kind of a exception of that slow grind to the move, and this is something that I also covered in the video about the algos. When you have this kind of move, you can expect a large flush, because there is just lot of orders are just building there, everyone is going long, and then the market will just hit a level which in this case was filling of this liquidity gap basically, and it will just kind of flush down from there. Okay, so this is simple breakdown of different price action principles and how markets are essentially moving. And now we are going to talk about more of a specific situations.